Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets.
New York coffee. The market right now seems to be the story of two bearish pitchforks. And it was the story of two moving averages, though not anymore. The first bearish pitchfork is the dark blue breached twice and repaired twice, early February to early March bearish shift pitchfork. We're right now a little above the dark blue lower tine, currently at 307.10, as well as just above a small band of congestion between 309.90 to 410.80. The second pitchfork is the more recent and larger bright red early February to late April bearish Andrews pitchfork. On this one, the market is right now playing with the declining middle tine, and that's currently at 316.90. And there were the two moving averages, or should I say there were two moving averages. The first is the short medium moving average, currently at 362.70, which runs just above the dark blue upper tine, and which 3 weeks ago and on occasion since helped, along with the upper tine, to cap the market with a horn top pattern at the start of June. The second moving average had not seen the market touch it since November 23, so quite a long while ago. It is the slowly rising gold long moving average, currently at 330.90. Now this moving average, along with the short medium moving average, were the market's senior participants. However, last week the market sliced down through the long moving average as if it wasn't there. So we will have to look elsewhere for support ideas. Thus, last week I suggested to look elsewhere, and we have below a support zone between roughly 325 down to 320. And as I said last week, and I quote, "This is a crucial level, as if this is tested and we could be looking at a pretty large bearish pattern here. Then we could be looking at a pretty large bearish pattern here. We might have a possible whole of 2025 very large double top pattern." Now, this hasn't happened as yet, but it's worth considering it and especially remembering. Thus, whilst they are not targets yet, we might have a primary potential down in the 263 zone and a secondary harder to reach potential down in the 229 zone. End of quote. Well, a couple of things to digest on this. Late last week, prices pushed down below this 325 to 320 support zone. Down through a 50% Fibonacci line at 312, where are we? 335.15, down through that as well. And they pushed down below almost to the support between 309.90 to 310.80, made up from the May 2011 high at 309.90 and the 50% Fibonacci line of the May 24 to February 25 move at 310.80. This now formalizes those targets below of a primary target X down at 263 even, and a secondary, harder to reach, seemingly much harder to reach target X1 down at 229. Today we've tested the supports at 309.90 to 310.80, but so far we've rejected back upwards. Further down we have a congestion zone between 301.50 to 303.40. as well as the rising purple neckline currently at 299.80 of the small August to October 24 head and shoulders continuation pattern. Below this is the beginnings of various stratified supports from September 2011 high at 290.90, quite widely spaced I have to say, until the congestion at 252.20. Finally, there's something else I'd like to look at here, and for this I'm indebted to Ray Bradbury for asking me about New York coffee 18 weeks ago. And I went at the time to my longer term charts, the monthly charts, where we can see some possible insights. You see, on the monthly longer term charts, I noticed a pattern that had not been immediately obvious to me at the start of 2025 when I last reviewed the longer term charts. It is a multi-year 2012 to 2024 very large reverse head and shoulders bottom, a bright red neckline on my daily chart currently at 274.90. The break higher over this neckline had already reached its primary target, but there was a secondary harder to reach, much harder to reach target X up in the 433.35 area. What was interesting about this secondary target is that nearby is the next 100% projected Fibonacci line here at 433 3/4, quite close in the scheme of things. So what does this mean? Does this mean the market will turn at these levels? Up to last week I was not able to say, though we did have a monthly shooting star pattern, usually seen as a bearish pattern, in February, an indecisive doji cross with a long tongue topside on the top of it in March. But then April was a bullish engulfing pattern, something which is not that surprising given the previous month was an indecisive doji cross. Though the month of May made a significant pattern, a bearish open and close long black Mariboso that dropped down through and closed below the important 50% projected Fibonacci line at 347.20. Thus prices for the first time in May closed back down below the dark blue upper time, currently 379.80, of the interesting 2019 to 2023 bullish Andrews pitchfork. So far in June, whilst we have sidled up over the 50% projected Fibonacci line, we did not stabilize over it, and we've dropped down to new lows not seen this year. 3 weeks ago, I sided with the topped out camp. I sided out with the topped out camp idea. And as I've said here for months that, and I quote, if there was ever an area where the market could hesitate on the top side, then this 433.35 to 433 3/4 area would be a reasonable choice, end of quote. Below, we now have the rising 1 year moving average, currently at 316.60, the 2011 high at 309 even, and a dark blue middle time, currently at 303.90. These will be reasonable supports, I would think, so just be careful of any reversion back up, though as I indicated earlier, it would seem prices may be trying down towards the bright red neckline below, and that's currently at 274.80. London coffee. 25 weeks ago I drew a new large pattern that for a considerable time encompassed all the significant elements within it. Towards the end of May, the market breached and then broke down through what was a very large shallow bull channel. Prices carried on lower, pushing down through the 50% Fibonacci line, the May 24 to February 25 move at 45.55, as well as the June 2024 high at 43.95. I said of this bearish pressure 8 weeks ago, and I quote, they now have the overhang of the market from roughly 5,300 up to this year's high at 58.49, sitting above, end of quote. Well, we now not only have the overhang pressing lower, but also the impactful force of the break below the shallow large bull channel. Thus for such a break lower, we had a primary target down in the 41.64 zone, reached 2 Fridays ago, and a secondary harder to reach target X1 down at 35.15 down at 35.15, with a tertiary much harder to reach target X2 down below my chart in the 28.60 zone. So what do we have in the way? Well, I recently drew a bright green mid-February to late May bearish Andrews pitchfork. We still had the bright green lower time available as support, currently at 37.61 until Friday last week, when prices pushed down below it and also closed below it. And the first of a pair of interesting 50% Fibonacci lines. And the first one is for the November 21 to February 25 move at 38.08, which we have closed below. And the second 50% Fibonacci line is from the May 21 to February 25 move at 36.49. To be honest, as I said 3 weeks ago, and I quote, if we manage to break the August 2024 low and a congestion that's just above it, then I'm not sure how strong these 50% Fibonacci lines below will be, end of quote. And that still seems to be the case. We have some suggestion at 35.53, but I think a move down towards target X1 may be on the cards. Then we have a fairly free zone below that, down to the combination of the January 24 high and the May 24 low, both in the 32.59 to 32.61 zone.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.